The stock market is currently closed today on Sunday, July 5th, 2026. The latest closing price for DVLT Inc., trading under the ticker symbol DVLT on the Nasdaq, was recorded at $0.3841 as of Thursday, July 2nd, 2026 at 4 p.m. Eastern Time, representing an intraday downward movement of minus 4.90% during that final trading session before the holiday weekend. While casual market observers looking at a stock trading under 40 cents might dismiss it as a neglected penny stock sliding into obscurity, a look under the hood reveals a massive surge in institutional transaction volume that completely upends that narrative. During the last trading session, over 34 million shares changed hands, a significant deviation from its historical trading baseline. This quiet transfer of millions of shares suggests that behind the scenes, institutional accumulation or restructuring is happening at a pace that retail markets haven't yet factored into the price. The common expectation among retail investors is that DVLT Inc. is simply another struggling microcap tech firm that changed its name from Wisa Technologies in early 2025 just to catch the broader market enthusiasm surrounding automated intelligence. The reality is far more complex and dangerous. This is a high-stakes financial reconstruction involving extensive corporate acquisitions like NYIAX and Cybercatch, backed by a massive corporate projection of $200 million in full-year revenue that is heavily back-weighted toward the final months of the year. The tension between what the public believes and what the financial balance sheets indicate is creating a massive gap in sentiment, making this corporate transition one of the most volatile situations in the microcap tech space. To truly understand why the trading volume exploded to 34.01 million shares during the latest session, we have to look at the day's wild price swings, which saw the asset bounce between an intraday low of $0.3838 and a high of $0.4567. For retail traders managing an individual brokerage account or tracking daily market movers through the Robinhood app, these multi-percentage swings offer massive trading liquidity but also present immense capital risk. Those who focus heavily on Robinhood stock trading or manage short-term speculative plays within their Robinhood investments often view these microcap fluctuations as simple momentum cycles. However, the ownership structure of this asset reveals that public retail investors hold roughly 62% of the float, while institutional investors and mutual funds lock up over 35%. This substantial institutional presence is highly unusual for a stock valued at under 40 cents. When major institutional entities maintain positions in an asset experiencing a severe downward trend from its 52-week high of $4.10 down to its recent low of $0.25, it usually indicates they are playing a much longer regulatory game. This dynamic stands in sharp contrast to how everyday retail capital enters the market. Investors looking at mainstream options might allocate their long-term capital toward a stable investment through the Fidelity trading platform or use specialized automated assets like Fidelity ETFs and Fidelity mutual funds to capture reliable growth. When someone opens their Fidelity mobile app or reviews their Fidelity wealth management strategy, microcap digital asset companies rarely make the cut, yet the high volume of block trades we are seeing suggests that sophisticated capital is actively treating these lower price levels as an aggressive accumulation zone, ignoring the negative retail sentiment that has plagued the stock since its latest earnings update. This divergence becomes even clearer when we compare how retail capital spreads across the broader markets. On any given day, the vast majority of retail trading volume on investing sites focuses on market behemoths, with investors looking for technical breakouts in Tesla stock, checking the long-term institutional stability of Apple stock, or chasing the historic computing chips demand driving NVIDIA stock. These megacaps set the tone for general market health, and their movements dictate how major institutions rebalance their automated indexing systems, such as Schwab Intelligent Portfolios or other online investing algorithms. When macro liquidity is tight, capital tends to flow upward into those massive safe havens, leaving microcaps starving for market volume. But when microcap volume suddenly spikes independently of what Tesla stock or Nvidia stock are doing, it tells us that a highly localized catalyst is driving the action. People using online investment platforms for self-investing have to look past the macro index movements to see the structural shifts within individual microcaps. Whether you are using the SoFi trading platform to build an aggressive portfolio or utilizing interactive brokers trading to execute complex options orders, finding an asset with a market capitalization of just over $331 million that is moving 34 million shares a day requires looking deep into specific balance sheet adjustments rather than broad technical trends. The core tension affecting the stock right now stems directly from the market's reaction to the first quarter earnings report for 2026. On paper, the company reported a net positive surprise, beating the consensus analyst earnings per share forecast by posting minus $0.09 against the expected minus $0.14. For an early-stage data firm, a bottom-line beat of that margin would normally spark an aggressive market rally. Instead, the market reality fell far short of public expectations, and the stock plunged nearly 15% immediately following the announcement, tumbling down to 50 cents before continuing its slide into the 30s. The reason for this aggressive sell-off, despite beating the earnings per share estimates, lies in the underlying financial metrics that came to light. While the firm pulled in a first-quarter revenue of $3.42 million, its operating expenses skyrocketed, with selling, general, and administrative costs breaking past $25 million, alongside research and development expenses hitting $5.73 million. This immense cash burn rate terrified short-term traders who were hoping for a rapid shift toward profitability. The company currently maintains a liquidity buffer of $250 million, with $140 million in active working capital, largely kept alive through recent private placements that diluted existing shareholders. Please drop a comment below sharing your thoughts on this operational strategy. Do you believe microcap tech firms should focus entirely on aggressive acquisition spending, or should they prioritize cutting corporate overhead to achieve immediate profitability? Comment below how many shares of DVLT Inc. you currently hold in your portfolio, or if you prefer keeping your speculative capital in safer vehicles. Understanding this balance sheet structure is vital for anyone engaging in online investing without professional oversight. When retail market participants use tools like the SoFi Robo-Advisor or Standard Fidelity IRAs, their capital is automatically insulated from these highly dilutive private placements. But for individuals who engage in active self-investing through an interactive broker's account or track high-risk setups on the Robinhood app, the structural reality of share dilution becomes an ongoing obstacle. DVLT Inc. currently has over 855 million shares outstanding, a massive share float that acts as a heavy overhead resistance whenever the stock tries to mount a technical rally. Traders using the interactive brokers platform often point out that the high number of outstanding shares make it incredibly difficult for a microcap company to sustain a long-term upward trend without experiencing massive institutional block buying or corporate share buybacks. The high volume we saw in the last trading session could very well be a sign of major stakeholders absorbing the remnants of recent private placements, trying to stabilize the asset around these multi-month lows. For users evaluating their choices among different investing sites, knowing the difference between direct market execution and localized retail order routing can be the difference between catching a clean breakout and getting trapped in a liquidity flush. While platforms like SoFi Invest or basic Robinhood cash management accounts offer excellent consumer accessibility, they are built for broad market accumulation rather than navigating the complex microcap order books where institutional algorithms execute block trades at a fraction of a cent. To evaluate where the business is actually heading, we need to look past the current financial distress and analyze what the company actually does. Operating from its corporate headquarters, DataVault Inc. transitioned away from its legacy framework as WISA Technologies to position itself as an intellectual property licensing entity centered on automated intelligence data agents, web ledger tokenomics, and enterprise data management. Their business model relies on securing global patents for secure data transmission and tokenized network security, then licensing these frameworks to larger enterprise clients. The centerpiece of their current growth strategy is the rollout of their proprietary